Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Tuesday, November 21st. We got just one economic piece today on the calendar, and tomorrow we'll get a bunch more. Everything's kind of congested into that one day on a shortened week here. But today we got the existing home sales for the month of October. So in September we had a 5.37 million accumulated growth here of 5.37 million existing home sales, and the forecast for October was supposed to bring it up to 5.45. And it came in at a nice 5.48. So again, we're still seeing very strong numbers, but it kind of makes you wonder if we had more inventory, how much higher that would be. So housing is very strong still. I know from experience from my side of things, we have a lot of buyers out there, and but would like to buy. It's just they can't find anything. And then in the same return, I've my conversation with realtors. They want to try to get listings, but the problem is a lot of people don't want to list their homes for that same particular reason. They can't. They're afraid that they're not going to be able to find a place for them to move. So we got this kind of vicious cycle going, moving around in circles. At some point, we'll hopefully get around it and move forward and try to get at least back to normal levels here. So let's go ahead and take a look here at the headline news. And right now the stock market is up. It's taken most of its cues actually here from the corporate earnings. It did like of course, the existing home sales, but corporate earnings have been kind of coming in today. Been kind of looking at some of the better than expected earnings results coming in, especially heading into here the fourth quarter and heading into the holiday season. They want to see, especially on the retail side, things pick up a bit. And then comments by Janet Yellen. The main comment she basically stated was that she's not going to continue on as a Fed governor when she's being replaced by Jerome Powell as the Fed chair. She had the option to stay until 2024, her term, but she decided once that's finished, she's going to go ahead and step down. So that'll give another seat for President Trump to appoint a Fed governor to that seat. So let's go ahead and take a look here at the bond market, see what's going on over here. So rates are about the same. This graph is showing us about 6 basis points up higher. We were up a little bit lower, but as I've done this graph and started creating this, it's actually right now it dipped down to about 3 basis points higher. So rates are about the same as where we left off. Hopefully we kind of keep in the upper range here. Right now we're kind of in the middle, but the big thing here is trying to get above this 200-day moving average, because once we can get above that, we're free to get almost another little over 1 point in pricing, which would translate at least a good 3/8 rate improvement there. Whereas right now we're getting kind of pushed lower, and we could potentially get a little worse pricing here. So as you can see, this 102.4 and 102.6, that's basically 20 basis points, almost a quarter point in pricing. So that could translate to about at least 1/8 here in pricing. All right, so that kind of gives you an idea of what we're talking about in terms of these mortgage-backed securities. Where you see 102.40, 102.60, that's 20 basis points. So if you obviously get to 25 basis points, that's 1/4 of a point. So a quarter point translates probably about roughly about 1/8 to the interest rate in pricing. So let's take a look here at the 10-year Treasury, where again it's staying above this 200-day moving average. So for rates to get better, we need this 10-year Treasury to go up, yields go back down below the 200-day moving average. We also need the bond market, as we'll go back here, we need this above this 200-day moving average. But right now things are looking more on the yield side of things. But one thing that's still, again, one of the things that's a concern is that our yield spread, as we may have talked like last week about, was our curve is actually starting to get or shorten up a little bit more. At one point earlier, about a week or so ago, we were about 69 basis points. Now we're closing in about 60 basis points from the 2-year Treasury to the 10-year Treasury. And so look maybe towards middle of next year to late next year that potentially that could become an inverted curve, which would translate that we're kind of approaching a recession. So what that primarily means is that it kind of forces us into a recession. And why? Because the spreads between the long term and short term are what the banks make. So if the banks aren't making the money, they're not going to lend money. So therefore, credit freezes up, and it becomes basically difficult to do business. So just to kind of give you guys a heads up what to be looking for in the near future here. So that pretty much wraps up everything today. I hope you guys have a wonderful day. But if you guys want to get more data, just come over to Twitter. You can find me on my handle at Mike Bjork. I do post data throughout the day, and hope you guys enjoy it. And if I don't see you guys before Thanksgiving, have a happy Thanksgiving. Take care, and bye bye.